In this episode, Ryan and I discussed 1090 policies in depth with particular examples from actual cases. We had fun and hope you enjoy listening. Thank you. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
And I'm your co-host, Ryan Griggs.
And now listen, this is going to be fun, whether you love us or hate us. Probably done more prep work here. I have done more prep work here than I ever have. And there's been so much redacting going on, I feel like a CIA lab. So,
either that or the FDA, huh?
Or Pfizer or Moderna or whatever, but we're not talking about juicy jabs or any of that. But we should talk about the mortality experience of life insurance companies in the future. Okay.
Which we mentioned on the follow-up episode to the think tank in February. So there's some of that in there, but...
Well, I'm talking about going a little more in depth because this is a little more in depth, but still, there's still more to come. I know I don't want to throw a carrot out there. It's meant to be encouragement to Mr. Griggs, who's a busy man, busy schedule, to work this longer content in. Okay. And so here's this, what we're going to talk about today. We've talked about many times in the past, but maybe not quite to this detail.
This is a specific example.
There's several specific examples, but one in particular that's your client that going deep in. And what I want to say here is we've talked about it. There'll be more to talk about, but this specific example, all of what we're going to talk about today comes from interactions with clients, past, current, prospective clients, cases, and individuals that we're currently respectively working with. So, this is not material just to have something to talk about and to make an entertaining episode on a podcast. What goes on here affects people and their families, right? There's a bigger cause than just a viral episode of a podcast. Okay. So break it down for us, Mr. Griggs.
Okay, so this is, and his name, we're going to call him Bob. Bob is the client. Bob does well. Bob's 45. He's in good health. He has no dependents. White-collar worker. No intention really of retiring in the conventional sense. Going to work for as long as God lets him. Bob discovered IBC maybe a year or so ago, and he went online, as we do, and did started doing his research, and last year acquired two policies from two different, very well-known companies.
Big Four
companies. And they are, like you said, we've talked about this before, they're 1090 contracts, right? And I'm going to say premium numbers. Don't let the premium numbers scare you. If the numbers scare you, just shave off a zero or something, okay? So it's $90,000 in total premium. $50,000 is going to one contract. That's built 1090. $40,000 is going to another contract, built 1090. Both contracts are from the same agent's office. Not going to say the agent's name, comes from the same guy. How do we know this? The agent's name is printed on the damn illustration. And that, if you know what you're looking for, right? This is one of the things I was saying on Facebook. I did a whole Facebook post about this. It's like,
yeah, but when did you make the Facebook post? Because that's a really good post that you should.
Yesterday, so early March.
So
2022.
310. Okay.
I'll turn them into blog, full length articles.
You know he will.
Yeah, because I'm going to go to 10 because this is such a great case of the consequences of the 1090 approach versus what could have been done, because these policies are, like I said, they're just brand new last year, right? And so what I want to do is highlight some of the particular riders on one of the contracts in particular, a blended term PUA rider. I then want to discuss another separate problem, the provision of an incomplete illustration, and why that's done. And we have some examples of why it might be the case that an incomplete illustration is provided.
Right. So there are several cases. Those are one case, two different companies, right? And we have, I think, 5 other cases with 3 additional companies, right? So this is not, we're not just picking on one company or one, agent or one office or one advisor or even one construct, right? Okay.
Yeah. And I'm glad you said that, because people say, well, I can imagine people saying, well, they should say the company, like, tell us who to look out for. And it's like, that's not the point, right? The point, the example is to demonstrate one particular manifestation of this problem, right? The important point is the principle, right? The idea, the concept. Like you've said, if you don't understand the concept, the details don't matter. But if you understand the concept, the details don't matter.
True statement.
Like, you need to be able to see this in whatever company it might come from, right? So it's not about the particular company. It's not about the particular agent. These are just examples that illustrate the broader concept. So that's why we're not going to name companies or individuals. It's not about that. It's not about them.
It's really not.
Yeah.
It really, and I've said it many times, I'm going to continue to say it. This construct, this mode of doing business, this operation, is an example, an application of the continuation of flawed thinking.
Yeah.
Right. Because, the agents, you get a license. It's the easiest license to get besides a driver's license, a life insurance license. And I know we both know that there's a lot of life insurance agents that listen. We appreciate you, the regular listeners. We appreciate you. And we also know that there are a lot of agents that like haters that like to listen. And the reason they keep listening is because they keep learning, right? Even though they want to disparage Nelson Nash, the IBC, construct, and never give Nelson credit, and disparage NNI, and then disparage us personally because we're too harsh or, whatever. Then why do you keep listening? Oh, wait, I just answered that. Yeah. Okay. When the potential consumer has the ability to understand what's going on, they would never do any of these. They would never purchase these, what I've originally called Frankenstein illustrations. They would never purchase contracts built like this.
Right. Okay. And what makes this particular case with Bob so illustrative is that because the contract's so new, the 2 that he already has, because they're so new, it's very easy for me to go create what would have been done had he just started correctly in the first place, and then compare the results, and which we'll do here. And the results, long term, late life, age 70, we'll use as a benchmark, is millions of dollars of difference.
Right. Let me say this, that there is third-party software that exists that agents like this use to disparage policies that have been in force, right? And we're talking about illustrations, and we all know illustrations are not right and they're wrong when you print, because over the long period, dividends go up and dividends go down. That's beside the point. Here, by construct, you're limited. The owner is limited on what they can do, right? So this is not a comparison of using third-party software so I can manipulate the numbers, because all of what we're going to be going through and talking about and looking at is, and they are illustrations that are manipulated to the nth degree. So it's why I don't use third-party software, to analyze what you have in force and compare those numbers on that illustration. I'd get an in-force, my example, I'd get an in-force illustration on a policy that may be 4, 5, 6, or 7 years old. And then the agent would create a new illustration that's highly manipulated, right? And then they would use a third-party software to manipulate you, right? And so I just want to make that.
Yeah. And our use of the illustrations today is unlike the common approach, which is all about the numbers. Oh my gosh, what's the expert analysis of that number is bigger than that number. Oh, wow. This is reading the language, the English words describing the structure of these policies.
Some of this print is in bold.
Yeah. And repeated more than once, but still ignored, or in some cases, just eliminated from the file that goes to the client. Yeah. This happens. And my understanding, it's always on the various illustrations that the illustration is not complete unless you got all the pages and the agent signs it.
I have that highlighted. Somewhere on every illustration, this exact or similar language exists. This illustration is complete only if all pages are attached and the producer's name and address and signature appear.
Yeah.
All right. So when you mentioned earlier the agent's name is always at the bottom. Prospective clients send us illustrations, and invariably, most of the time, the agent blacks out their name, right? But then generally always, they forget that one page that they didn't black out the name. So the illustration is incomplete unless all pages are present and the agent's name is on there. I wonder if there's something in the law about that.
Yeah. Okay. I'm sure insurance commissions would love to hear about that practice. But okay, so getting back to Bob. So again, 2 policies. We have an incomplete illustration for one of the policies.
On purpose.
Yeah. In fact, I asked the client, talked to him yesterday, did you know that it's unethical in the least?
Well, you asked him if he had the other pages.
Yeah. And he's like,
no.
What?
What?
Yeah, it was news that there would even be other pages. So he hadn't received them, and I've encouraged him to, of course, go and get it. And pure speculation, but I think the idea is that a disclosure that would appear on those pages has been eliminated.
And that disclosure says, this illustration shows one or more PUA payments after year 1 that exceed a specified multiple of the base policy premium. The multiple is 3 times the base policy premiums in years 2 through 10. So there's a 1090 illustration, 10% to the base, and then 9 times into the PUA, which violates that company's structure beyond the first year. The multiple is 3 times the base policy premium in years 2 through 10. So if I paid a $10,000 base, I'm only guaranteed by contract to be able to pay a $40,000 total premium, right?
But I'm going to illustrate
Yes.
90.
But I'm not going to show you the whole illustration because I don't want you to see this disclosure, right? And then that ratio is 1 times the base after year 10. So a year 11 and beyond, it's only 1 times the base. So if I'm paying $10,000 in base premium, I can only pay by contract $20,000 in year 11 and beyond. All right, it continues. One of the conditions, payments in excess of this limit are subject to approval. One of the conditions may be that the insured provides satisfactory evidence of insurability. So that is not a guarantee. Right. If the company doesn't want to receive premium, they can just increase the underwriting. I mean, they can't willy-nilly increase underwriting and decrease underwriting, right? But if they don't want to take the premium, they'll require you to go through underwriting. Okay. So when I have talked many times about the contractual obligation is always the base premium, whether you write the check or not, the base premium will be paid. Whether you do a premium offset, paid from dividends, reduced, paid up, that's the obligation, is the base premium. The riders, you're not even obligated to pay the premium for those riders, most of which you would want to pay, right? And then the minimum PUA premiums, that's an obligation if you want the PUA premium. So, and my point here is there's an obligation. A portion of your premium is an obligation, whether you write a check for it or not. And then there's the PUA premium, the other riders would be a contractual right that you have to pay, not a contractual obligation. So the contractual rights that you have are shredded on this, with this particular company, with that, 1090 design or any other design that violates that.
Yeah. So in this particular case, the total premium is $50,000, $5,000 of which is going to base. There's an annually renewing term rider in here, which is a whole other thing that I don't like. And it's the $50,000 is illustrated paid from age 45 to age 56. 12 years. Mind you, white collar worker, high income, no intention of retiring, age 57, can't pay any more premium into it. And that's on an incomplete illustration that assumes that the full 50 in the years prior is even payable, which, as the disclosure you've just gone over, which, by the way, that disclosure comes from the same company as the one I'm talking about now.
I've talked about this before, and then there's some videos that have been put out that cursory mention this. A pretty good agent pointed that out. But the contract says something different. By all means, let's see the contract, because the illustration is not going to have one disclosure and the contract have another. All right, so.
Yeah. And the policy is built based on what's illustrated. That's the foundation of the entire contract. All right, so that's the one, right? And, there's, maybe that disclosure's in there, maybe not, probably is.
It depends on how it's illustrated.
Depends on annually renewing term, right? The amount of, why do we use term? We use term to increase the death benefit in order to allow for a high PUA payment as a proportion of the total outlay in a non-MEC, tax preferable fashion, right? So people use term. I use term. Nothing wrong with term in general, but what I don't like is this 1 year term. And you've put it before, 1 year term, OYT, annually renewing term, all that refers to the same thing. I liked how you've put it in the past, is that, if it doesn't fully, it gets this close to violating the principle of insurance. Because and in fact, there's a line in here somewhere that says the premium for the 1 year term is not guaranteed. I don't know where it is, but the problem is that as we get older and our attained age rises, so too does our mortality risk. And it does so in an exponential, nonlinear fashion. And so the death benefit per premium dollar becomes more expensive at an exponentially rising pace over time. And every time there's a renewal, which in the case of 1 year term, annually renewing term, is every year, there's a recalculation of the premium that's due for the amount of death benefit included in that rider. And who knows what the mortality experience of the company will be in the future. And it might turn out that the mortality experience is different than what it was originally illustrated.
What? Like 40% increase in one particular company in the last quarter of last year and a general 10% increase across the industry? What could go wrong?
Yeah. And so this is this one primary one that I'm talking about, the $50,000 per year for 12 years. It's got an annually renewing term on it. The other policy, $40,000 total premium, also 1090 structure, has another kind of annually renewing term rider on it, one that we call a blended term PUA rider. This is a rider where one premium is paid to that rider. A portion of it goes to pay the premium for an annually renewing amount of temporary death benefit, and the rest of that premium goes to PUA, where it purchases permanent paid up additional death benefit. And over time, theoretically, ostensibly, allegedly, the amount of death benefit that must be bought with that rider decreases, and the amount of permanent death benefit that's bought with that rider increases over time, such that eventually, at some point in the future, which they call a crossover year, no more term is necessary. And it's just PUA, right? So we're kind of ostensibly phasing out this annually renewing term death benefit. Now, will that happen? Who knows? But if it doesn't happen, the policy owner is responsible, right?
That's a very old concept in the life insurance business. Permanent life insurance costs more, the premium is higher. Temporary death benefit costs less, term. So you buy as much permanent as you can. And then we all have a need for death benefit. All of us have a need for death benefit. So you increase your total death benefit with term. So over your lifetime, you're supposed to earn more. And so you buy more permanent, and you buy less term, whether you drop it off or convert it or what have you. My point here is this blended PUA, nothing wrong with it per se, other than, what we're talking about here. And I want to say that this is a construct of the life insurance companies. Very old concept. This is just a version of that concept. Increasing cash value, your need for death benefit goes down in the future, blah, 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 blah. When PUAs, additional PUAs, the dividend being able to be, the dividend paid to the PUA has been out a long time. These high PUA, the ability to pay a PUA premium, above the dividend is relatively new. It didn't really exist prior to the 90s, right? So I just want to make that point. And let me see. If I pay a premium to the blended PUA, there's a charge. There's a charge on every life insurance company to pay the PUA premium. And every now and then a company will misconstruct a rider like that and not have a high enough charge. Well, they'll take that rider off, make it unavailable for new policyholders, and they'll correct that. So when you pay a PUA premium, there's a charge for the PUA premium. And it's anywhere from about 6% all the way up to 14% in the first year. Okay. And then in addition to that, there's 1 year term that goes up in price every year because you had a birthday 1 year closer to mortality. All right. Yeah. Oh, and then the non-guaranteed dividend that's paid or should be paid into the PUA, the non-guaranteed dividend. So how serious is your company even considering paying the future dividends that they're illustrating? It's a legitimate question. I don't know, but I have my opinions. So the non-guaranteed dividend that goes into the PUA is supposed to pay for the non-guaranteed rising cost of the term after a charge has been applied. All right. And all this is spelled out very clearly in your life insurance policy, which is a contract. And these disclosures and the language is, an awful lot of it is even contained in the illustrations.
Yeah. And in this particular case, that's exactly what's happening. The idea is that the dividend allocation is to this rider, right? It's to pay for this rider rather than just pure PUA, as Nelson on page 44 in Becoming Your Own Banker says it should. Pure
dividend to the pure PUA just dang near goes straight to dollar for dollar increase in cash value.
Right. Contributing to your ongoing compounding.
Yeah. And buys dollar for dollar death benefit and causes every future dividend to go up.
Right. So instead of that happening, we're going to shave off some unknown amount to go to annually renewing term that generates no cash value that buys death benefit that will fall off. Oh, okay.
Yeah.
All right. And then, so this is the exact language here of this writer. It says, keeping in mind that the dividend is supposed to be paying for the premium on this annually renewing term, the premium, the death benefit in which is becoming more expensive every year.
Therefore, it shows, generally illustrates that the term death benefit decreases.
Yeah.
Right.
So it says, it is anticipated, but not guaranteed, that over time the amount of term insurance will decrease and the amount of paid up additions will increase until the crossover year. The crossover year is the point in time when the paid up additional insurance death benefit is equal to the target face amount and the purchase of 1 year term is no longer necessary. And then here's the fun part. Based on the illustrated dividend schedule, the crossover for this policy does not occur based on assumptions in the tabular values and does not occur based on assumptions
not occur
in the supplemental values. In the event of a dividend decrease, the initial level of death benefit coverage may not be able to be maintained, even if all illustrated cash premium payments are made.
What?
Future additional premium payments may be required in order to maintain the initial level of death benefit. Oh, and by the way, the term charge rate schedule for the 1 year term insurance coverage is not guaranteed. I mean, we were talking about a contract the other day or some time ago where it's like the language is so broad you could drive a truck through it. It's like, why would all that verbiage be in there?
That narrows it down pretty good right there.
That they're saying that if what's illustrated, these illustrations aren't worth the paper they're not printed on. Like they're telling you that the company has the right to adjust the pricing. It's up to them. It's not up to you. And then if you don't pay it, oh, by the way, what's the MEC limit on this policy? Oh, is it $40,068? Is it literally $18 more than the contractual maximum allowable to be paid? Okay, so what happens when lo and behold, the pricing of the term goes up beyond what was expected, or the dividend is insufficient to cover, or both, such that the client then has to pay up, right?
Additional
premium payments may be required. Okay, so now you get to either make those, and by the way, this annually renewing term, it'll happen every year. And so if you don't make that additional payment, well, then what happens? Well, in the event of a dividend decrease, the initial level of death benefit coverage may not be able to be maintained. And so the death benefit might go down. The term death benefit might go down. Why is the term there? Oh, to prevent the MEC. That's how the amount of death benefit on the rider is why we could get the MEC limit $18 above the maximum contractual payable premium. And so if the policy owner is backed into a corner, either you pay up the additional money for the rider, where it's going to add additional death benefit that won't stay on the contract and it won't generate any cash value. Either you pay that in order to maintain the preferable tax treatment in that 1 year. Oh, and by the way, if you lose the tax treatment, that's permanent. It'll be treated as a modified endowment contract out into the future. So every year, this opportunity is going to come around where you could potentially be backed into a corner, pay the additional term amount, or lose some of the death benefit on that term rider. And if some of the death benefit is lost, the MEC limit will go down. In this case, it'll certainly go down below the contractual maximum payable premium, giving you the opportunity to MEC your own policy in the future. If you wanted to stick to this made up schedule of premiums of $40,000 for 21 years. Who wants that?
Nobody would buy these if they understood them. But look, Ryan, I don't want a death benefit. I don't care about the death benefit. I just want to become my own banker. I only want cash value. You hear that often. If a point like this is made, I don't care about it. Look, you cannot buy life insurance without a death benefit. Okay, now let's think about this. The guaranteed cash value of the base policy must grow to equal the face amount of the policy at age 121. And now if I'm going to collateralize, pay high premium into life insurance, and I'm going to enjoy that in the future, whether it's through withdrawals or loans, especially in loans, if I get into passive income time, I start taking loans to have this tax-free income that everybody wants to talk about and enjoy and try to illustrate with these monstrosities, policies that they're not going to happen. I'm going to take this tax-free income and not repay the loan, right? I might pay the interest on the loan. First I've got a premium offset, number one, because that obligation that I keep talking about is going to be paid whether you write a check for it or not. So the policy, even if you premium offset, is the premium is going to be paid, period. And then I'm going to take a loan, right? And maybe I start taking loans at age 70. And let's say it's a zero, it's just 5 parts to a future value calculator. Zero value now. The loan has no value right now. Then I take a loan of whatever, $50,000 a year for 20 years, and I assume a rate, the loan rate. I can calculate how long that loan or how large that loan is going to grow. And that loan cannot out compound the death benefit. So if I'm forced to reduce my death benefit in the future and take passive income through loans, it is not going to happen. And if it does happen without a problem, and then the policy MECs at year 80, what kind of a structure, support system do you have, sir or ma'am, or you agent? What kind of a support system do your clients have that will allow them or help them or ensure that they can manage an outstanding loan on a policy? I'm just saying, you need a death benefit. How much? I don't know. Other than what you need today, we can all calculate that. You have obligations, then you want to address your obligations. How much income or how much death benefit do you need in the future? I don't know, but I can use some simple math and get pretty dang close. And it's not going to be less.
Yeah. That's the other part. The death benefit in these of course, because there's annually renewing term, fluctuates, right? Rather than a nice steady increase over time, there's this fluctuation thing. And then, okay, so...
No, you're talking about flexibility. How much flexibility do I have in those? Are we there yet? Am I jumping the game?
No.
Okay. So, well, wait, before we go there, because I want to make a point here. I don't need the death benefit. I only need the cash value, right? So I only want to be my own banker, practice banking, but then shred everything that Nelson Nash has done and don't give him credit, rarely give him credit, or completely avoid giving him credit, right? It's like, it makes no sense. You want to talk about banking, you put IBC in your name, banking this, banking that, banking this, and banking that, and never give Nelson credit. Why? Because you don't know what Nelson did. If you did, you wouldn't do that. Agent, I'm talking to you. All right. But then it goes all over me, that I'm going to not give Nelson any credit for his work, but then I'm going to bastardize every damn thing he did. Mm-hmm. Don't cut that out.
And call it IBC.
AV Ninja. I meant to say those cuss words. Okay.
All right. So we cite this language that says, look, if you made, in fact, there's another passage in here. If the dividends together with your rider payments and the surrender value of paid up additions are insufficient to pay for the cost of the 1-year term, you will be billed for the difference. Failure to pay the difference will result in the target death benefit being reduced so that the rider is reduced paid in full. Okay, does that happen is the question. And the answer is yes. I have a little letter here from a different client, but has a policy from the same company.
What, you mean it actually happens? It actually happens?
Yes. So different client, policy from the same company with the same rider. Okay, so different client, but 1090 structure, might even be the same agent.
What?
Yeah. Gets a letter.
How old is the letter?
This is from 2020.
Oh, so they're still in business.
And
they must be doing well.
This policy had been in force for all of 4 years.
Oh, okay. I got it. Yeah. Okay.
Yeah.
I thought it was older. Sorry.
Conveniently past the clawback period on the commission, but that's a whole separate thing.
What?
Okay, so this little 1-page letter says that we're recommending. The language here is really something to behold. I mean, the mob would be, they'd be impressed. It's a recommended.
Well, you're drawing a distinction between them and the mob. Maybe the mob works there. Maybe they learned from the mob. Maybe the mob mentored them. I don't know.
I'm just saying the language is very interesting. So this says the current projected dividends combined with the current rider premium will not be sufficient to reach crossover. Therefore, we recommend the rider premium be increased as follows: from $8,133.25 to $8,757.49, an increase of around $600, maybe 8 to 9% of the total in the 1 year. 4 years into the policy. If you would like to make the change, please complete the enclosed blah, blah, blah by a certain time period. You are not required to increase your rider premium to the new recommended amount. However, declining to do so may result in 1, the need to pay higher rider premium in future policy years. The failure of the rider to achieve crossover to fully paid up insurance on your specified target date. Or, number 3, a reduction of the death benefit in future policy years. And then there's this insidious little line: you chose a specific amount of life insurance for a reason. It's like guilting you.
It's always a consumer's fault.
How you wanted this amount for a reason. And by the way, in the context of banking, there is a reason. The reason is to be able to pay a high PUA without causing the modified endowment contract.
All 3 of those things, either in totality or individually, are going to happen with every construct like this. All 3 of them are going to, it's a matter of time. And then we talk about the MET test, right? And you can look on the illustration, you can Google it up. Prove me wrong. Look, I don't know everything. I'm a student. I'm subject to be corrected. Right. Now, I'm not inviting a bunch of hate stuff, okay? The MET test is the same as a 7-pay test. He's in year 4.
Year 4.
And you know what? After the initial 7-pay test, there's going to be another 7-pay test and another 7-pay test and another 7-pay test.
It's
right.
Ongoing.
And so if you can avoid, look, a MEC is not the end of the world. Quote verbatim, Nelson Nash, which I have come to understand and believe. However, quote, continuing. If you can avoid it, you should.
Yeah.
Okay. All right. It's a matter of time before these policies become MECs and or you have to reduce the premium. Now, these are young people that we're generally speaking of. Every one of these cases these people are still young, producing, accumulating. They're not even in the prime earning years of their life. They are going to earn more. I mean, I choose to be an optimist. Okay. And you're forcing them to reduce the premium. It makes no sense. Okay, well, maybe I'll just go buy another policy. Well, of course you've got to buy another policy. Why? Because you got to go through that loss of liquidity. Although they squeezed that down as far as they possibly could, you still have to go through it again. So how many times do you want to go through that? How many times do you want to go through the startup period of a policy? 3 times, 4 times, 5 times? If these individuals were properly insured, properly capitalized, they would be forced to go through these things 2, 3, and 4, and 5 times. If they are able to pass underwriting.
Yeah.
Do you think that 1-year term is convertible?
No.
What?
Why would it be convertible? It's there for a year. It's supposed to go down. What, are they going to convert it into a whole? By the way, it's not going to be there. There's not going to be much of it there in 5, 10, 15 years.
So if you want to practice banking, you're forced to go through underwriting again. The older I get, just bought 2 policies last quarter of last year, 2021. I'm well seasoned in my age. I get standard. And in parentheses, right, they're given the reason that I'm standard and it's billed. I mean, that's the politest way ever of calling me fat, right? Which I appreciate getting standard.
Yeah, I'll take standard all day.
I could show you how. I don't want to go through underwriting no more than anyone else does, right? I surely don't want to be forced to go through underwriting.
Right.
Right.
To be able to continue to pay a premium.
Yes.
Yeah.
And then you're in that startup phase over and over and over. There is such a better way. And we're going to get to that. We're not even halfway there.
Yeah. So before I have cumulative statistics, like comparing how all that would work out, even if we make the assumption that we can believe the premiums on the illustration are payable, which is not going to be the case. But even if we accept that, we can look at what the non-guaranteed cash value is out into the future.
This is good. So I feel like Dr. Bob Murphy sometimes, and he's like, let me break it down for you. Not that you need it. I need it for me. Okay. So the young man here, without just assuming that the premiums can be paid in the original 2 monstrosities, which cannot.
But okay.
Pointed out, it cannot be done. It will not be done. But assuming that is done, compared, and he's going to go through all this, right? I feel like the Knight's Tale, the young blonde-headed guy from, the Knight's Tale, he died.
Ledger?
Keith Ledger.
Yeah.
The town crier, the guy that would walk out in front of him and, oh, hell, this guy, I feel like him. Okay, my point being is he did a great analysis here and is giving more grace than the 2 illustrations deserve. It cannot be done, and it's pretty much disclosed in every document that the client signs that it won't be done. But assuming that it can be done, I mean, just think how this is very powerful.
Yeah.
Then compared to what if you did it right and kept that, or what if you started completely over, which neither of us are proponents of replacing policies. If you have a policy that has some maturity on it, that is properly built, we, as a matter of practice, do not encourage replacement of policies. Disclosure.
Right.
Okay, sorry.
However,
that's supposed to juice you up.
Especially like in this case, the other policies are so new. If he did restart, he'd end up with more death benefit. He'd have better contractual. Everything would be better. But this little comparative analysis here. Okay, we assume the $50,000 remains payable into the 1 contract. We assume the $40,000 remains payable into the second policy, and then the client's desire was, look, I want to expand. I want to pay as much premium as possible. He has the income to support it. He has a unique situation with his company where the company pays for dang near everything. And so a lot of his income is just free cash flow. No dependence, right? Active in the lending of money to other people, family, business associates, right? He's got repeat borrowers. So he's already banking. He's just using cash to do it.
Probably charitable too.
Yeah. So the idea was, okay, I want to expand as much as possible. So scenario one is keep the contracts you have. Let's assume those premiums remain payable. They're not, but let's assume it anyway. And then let's expand as much as we can from a financial underwriting perspective with a properly structured contract. In this particular case, I'm just telling you, that worked out to another $80,000 in premium. That would bring his total premiums across these 3 policies, 2 that he already had, 1 more from me, to $170,000 a year. And that would be, that number though, is $170,000 a year payable for the first 12 years, right? Then because the structure of these other contracts, the total premium payable is going to start decreasing, right? Because the one policy where it's 50 grand for 12 years, that's going to shut off in year 13. Okay. So that means 170 goes to 120,000. And that it stays the same for another 9 years. Up until year 21, when the 40,000 no longer becomes payable. So the premiums into this system must decrease, because even if we assume generously that what's illustrated on those other 2 contracts will actually happen. But that's fine. Let them have that.
No, that is being generous, because it won't happen.
It won't happen.
It won't happen. It can't happen.
Yeah. So the idea is maximum premium for as long as possible while retaining the contracts he already owes and granting the assumptions on the illustration that are made up. And that starts out at 170,000. Scenario 2 is, if the idea is we want to pay as much as possible, okay, let's do that, but let's wipe the slate clean. Let's, setting aside these other 2, what could be possible then? Well, from a financial underwriting perspective, that number is a bit higher. It's 180,000. So 180 versus 170, they're close. But because the 180 would be built with sufficient base and a proper long-dated level term rider, that 180 is payable for not 12 years, not 21 years, but 30 years. Nice long
contractual right to pay that long of a time period. And properly designed, it allows him to pay more premium. The others used up too much death benefit or his insurability, right? When I use the word contortion, Frankenstein, I'm being very lazy in language, but that's part of it, right? You can't even pay a proper premium that you want to and have the ability to. So,
yeah. And so in this case, 30 years, that would mean from 45 to 75. Look, he may be paying a big ol' high premium in years 25 to 30. He might not. He has the right to, but he is not bound to. But we give him that right if he should want it.
And compared to the contractual right. I mean, the obligation compared to the right.
And so that's a very simple, the solution is so simple. Long dated level term rider, contractual authority to pay the premium for as long as possible. Assume that all the other stuff we can keep in force, whatever. Okay, so the question is, what's the long-term effect? Well, let's pick a year out in the future. I picked age 70 because it's a nice round number. The cumulative cash value, non-guaranteed, generous assumption, the cumulative cash value in scenario 1, where he keeps the 2 policies and buys as much as he can in a third one, the cumulative cash value across those 3 contracts at age 70 comes out to about $4.5 million. Big number, right? More than the cost basis. Not going to happen, because the cash value in the first 2 contracts is not going to get there. But
best case scenario, that can't happen.
Then scenario 2, 1 policy, very simple,
correctly built, properly designed,
maximum contractual authority, cash value, age 70, $7.27 million.
What?
4.5 compared to 7.27. Which, I mean, at some point, it's like, would you rather retain all of the contractual complications, all of the loss of control, all of the loss of the ability to pay a PUA, in order to achieve a lower cash value in the future? Or would you prefer maximum contractual authority for as long as possible with as little uncertainty as can be done in the business in exchange for higher cash value? In fact, not just higher, much higher, right? Like almost $2 million more higher.
Double percentages.
More than 2 million. I mean, it's like,
well, look, Ryan, surely that harmed him if he were to reevaluate and start over correctly. Surely he's harmed. He can't lend the money that he's been lending, right? He can't give away the money he's been giving away, right? I mean, he's got to be harmed. Wait, you're going to make more money. You know, your commission. Are you doing this for commission, sir?
Yeah.
I mean, what? I mean, surely he's harmed in some way.
and look, you know, it really pisses me off because the guy I like him a lot, Bob, and he listens, and you know, he's very upfront about this. It's like, you know, not super social, you know, not like a antagonistic kind of guy. I'm a little more disagreeable than he is probably. But now it's like, okay, I've got what I've got, but this is the honest representation of what could be.
Yeah.
And now you got to like unwind out of the prior contracts. And I'm making the guy feel bad about what he did when he did it in good faith. And I'm not trying to like criticize the decision just for the sake of it. But at the end of the day, that's what that is. And then there's something different. And the reason we talk about this, the reason we go through examples like this is not to beat up anybody in particular, but to make you aware that this is the alternative. This is the trade-off. And so in the Banking with Life hater group pages, where we're, you know, sending bad pictures of tabular details of illustrations
of those kinds
to us,
of policies.
of these policies,
yeah.
you know, with numbers that won't be payable, to argue about when, we're going to go cash on cash in year 3 instead of year 4. It's like, okay, all right. Yeah. What's that look like out at age 70? Never mind the contractual flexibility in the PUA. Never mind the disclosures that are eliminated from the cleverly cropped illustration files that are sent out. I mean, I've said before, like, assume angelic intentions, and I really try to. But at some point, there's so many layers of like, I don't want that. I don't want that. I don't want that. I don't want that. And the implications continue to get like worse and worse. And then the actions of the agent like are conveniently positioned or manipulated in order to conceal like the disclosures it's like,
that's illegal, immoral, unethical, shameful, disgraceful. And I'm ashamed that people like that are even in the financial world.
It gives the industry awful. And by the way, these guys are walking around. They've managed to find the letters I, B, and C on a keyboard.
Yep.
And so people who don't know better, and why should they, conflate that, you know, we're all the same. All those IBC guys, all those insurance guys are all the same. Okay. Yeah, we're the same. And that's why there's a over $2 million difference in long-term cash values.
Well, let me modify my statement. If the consumer was aware of all this, then there's no problem. Right. It's not the ugliness that I went through a minute ago.
And that's the issue. They're not aware. Okay, so one more layer to this fun stuff.
I don't have a single client then when we go through this that they were aware.
No, they never know. And I got to be the one, you got to be the one to break the bad news. It's like not pleasant, you know? But I told the guy, look, just like you said about replacement, if you don't want to replace them, if you don't want to go through that, fine, keep them. But if you're going to change anything, if you're going to change premium levels before you do it, I want an in-force illustration that incorporates that assumed reduction in premiums.
Can I have all the pages?
So as I was saying, in the scenario that I built, in both scenarios, in the smaller policy, if he kept the 2 and added 1 more, or if he started all over and got 1 big one, for both of those that he would get from me, the way the policy is built, and the company is chosen for this reason on purpose, among others, but the PUA can be paid on an unscheduled basis whenever the client
anytime
wants,
throughout the year?
Throughout the year.
I don't have to pay on the anniversary date?
Yeah.
Don't have to keep up with that? And hope the deals close on time, whether it's a real estate deal or whatever it is, or the bonus comes in, or the tax comes back, or however I'm going to pay that PUA?
Yeah, because the cash flow will always be there right when you expect it.
I got a HELOC, so I can just borrow against it. Nothing will go wrong there.
All right, so now let's talk about the PUA rider on one of these two policies, the one that we have the actual full illustration for. This part would be eliminated. Okay, so this is detailing the nature of the payments to this PUA rider. There are two types of PUA payments. They can be scheduled or unscheduled. It so happens, by the way, that in this policy, all the PUA is scheduled. The frequency, so this is point number one about scheduled payments. The frequency of scheduled payments must be the same mode as the base policy. The premium mode on this policy, by the way, is annual, which means that the PUA that is scheduled, that is illustrated, is assumed to be paid all at once on one day, and that day doesn't change at any point in time for the rest of the life of the contract.
Well, I have a grace period.
Yeah. You know. And then point number two, the scheduled payment amount can be increased or decreased after issue. Yeah. However, increases to the scheduled payment are subject to satisfactory evidence of insurability.
What?
Yeah. If the scheduled payment is reduced, all future scheduled payments will also be reduced. So you can lower it, no problem. But if you lower it and then in the future want to increase it, well, now that requires approval from the company.
Do you think this, and I know the answer to this question, and I generally don't like to ask questions that I know the answer to, but this is such an important question. Did the consumer know that?
There's no way. I mean,
do you know that if you own one of these monstrosities? And maybe you know that because you found that out, right?
The terms and conditions on PUA riders vary dramatically across companies.
Yeah.
And that is what it is. Okay, the next one. Okay, now to the unscheduled payments. An unscheduled payment is a rider payment that is not anticipated to be a regular event and is subject to satisfactory evidence of insurability. Okay, so either you're going to pay us, if you want the contractual right to pay a PUA with this company, with this particular contract, it's got to be scheduled. It's got to be scheduled at the same time as the base premium payments. If you lower that payment, you lower all future payments. And if you want to increase, well, then that's going to require approval from the company. And if you didn't want to do any scheduling at all, if you just wanted the ability to pay it throughout the course of the year whenever you wanted, well, that's going to require approval from the company too. It's like, how many, you're this close from not even having a rider on the policy. Like when
it's a matter of time before it's so restrictive that you can't do that. This is just in addition to all of the other things.
Yeah,
it is not going to happen.
This is about the payment of the pure PUA rider on the policy. There's that. And then there's everything we talked about before, which is the blended term PUA. That's a separate rider on the same contract. So the dividends assumed to be, and the premiums that are illustrated on the policy violate the ratios. What?
Well, that's on one company. This company, the other, there's two companies there. One company just clearly says it's violated, the ratio. The other company has 6 pages of disclosures on their PUAs. And this is where you're pulling this information from. So the devil's in the details. That's where he lives, right here in the PUA disclosures, right? And it does matter from company to company. It matters to you. And, when it comes to I don't care what the construct is, 1090, 80-20, 85-15, base to PUA ratio. If your policy is constructed like my policy and it's constructed like their policy and it's wrong. Shouldn't you be treated as an individual that you are? What you're going to do is not what he's going to do, which is not what I'm going to do in the future, which is all unknown. It makes no sense to me that this is whatever this is IBC and this, whatever I'm promoting is how you do it.
Yeah.
It is like appalling. It's almost like you can't get it off of you. But you surely, once you see it, you cannot unsee it. Right. Once you know, you don't have to relearn.
And to be fair to this company, there is a catch-up provision. It's a rolling catch-up provision. So if scheduled payments were missed, then you can make up for them in a following year.
1 year catch-up?
I think it's 2. The catch-up provision is only in place after the 3rd policy year, and the duration of the catch-up period is 2 years following the missed payment.
Okay. So I got to pay the high premium for 3 years, or there is no catch-up.
Or there is no catch up.
And if I pay that for 3 years, then I can catch up for 2 years. Well, it's more generous than I thought. I thought it was a 12-month catch up.
Yeah.
But these companies change riders from time to time. I'm just saying that.
Again, and it's not about the particular company. It's not about
That's a great company.
Yeah. Been around a long time.
Both of these are great companies.
Yep. And so it's from the perspective of IBC, the question is, what is the nature of the contractual authority as it pertains to the management and funding of the policy? And that you should at least know that. Like if for whatever reason, the big four is what you want to do and that's what you're going to, okay, but at least know what the ramifications are of any variation whatsoever from what's illustrated and what you actually end up paying. Like, at least know that.
When we talk to clients that have been exposed to this, if they listen to prospective clients, listen to this podcast over time, there's hundreds of hours, I don't know how many, a lot of hours available at no cost on this channel. And I know that most people don't want to get up and be a life insurance expert. I get that. Most people still today, even in the digital age, they make a decision based on trust, right? They listen, they like us, and they feel like they can trust us. But that is across the board. They've listened to the promoters that do this, and they've decided to like them, and they've decided to trust them, unbeknownst to them what they're really purchasing. The consumer doesn't know. So when you cannot make a decision based on numbers on a page, because all of these are heavily manipulated, the illustrations.
Yeah, the numbers look great.
So you will say yes. And they're manipulated where there's a highest cash value as soon as possible, right? So then wait, you're violating Nelson's number one fundamental rule. Think long range. If you can't think past next year, proper IBC is probably not a good fit. And it's okay. Violation number 2. Don't be afraid to capitalize. If you have to borrow against, collateralize every dollar that you paid in early, then you're afraid to capitalize. You're afraid to pay a premium. And it's okay, right? I mean, fear is fear. Just be educated and be courageous. And then, it's the whole point of like becoming your own banker. Number 3 is don't do business with banks, i.e. don't be dependent upon third-party lenders. Well, if you have to go do a HELOC or you have to collateralize some asset to pay the big high premium in year 1, then you're becoming more dependent upon the third-party lender. And then so you can leverage that asset that you just purchased. That's a contractual obligation that you have to the life insurance company. You are borrowing their money. So you're compounding your leverage. Now, I'm not saying that can't be done and you can't win. I understand leverage. But is that really what Nelson is that really what he taught? Is that really becoming your own banker? And I say, no, it is not. Right? And then this is flawed thinking continued.
Yeah.
Okay.
Yeah.
Well, if my flawed thinking continues, don't steal the peas, right? Think long range. Don't be afraid to capitalize. Don't steal the peas. Well, if I have to collateralize every dollar and I had to collateralize assets to purchase this other asset, to collateralize this asset, to purchase another cash flowing asset, and the premium is due, and I can pay these high PUA premiums or make a loan repayment, I'm probably not going to do both. I'm going to slam it down to the bottom, the premium, and I just want to pay 10% because that's my obligation. These haters take our language and Nelson's language and Nelson's work and twist it up enough, but then they still listen. I have it in print because I still get a nugget every now and then. It's because you don't know a damn thing, sir. And so maybe you should get out of business. Maybe you should stop doing this to your clients. Okay, I digress, but you do what you want. I'm telling you, these policies generally don't have a great history of loan repayments. All right. And then, that's a very specific case, but it continues in other variations. I've got a whole stack of how much time are we into this?
We're on an hour.
Yeah. Maybe we'll do a part 2. Universal life, the same thing. All right. You have these illustrations. They illustrate very well. You have this big old accumulated account value. And then they're starting to twist up the language in the life insurance industry. You said it twice earlier, the language out of this whole life policy with this twisted illustration with the blended PUA, that a target death benefit. When the word target is historically, specifically describes target premium, target death benefit on universal life, which brings me to the point that universal life is, violating the very essence of insurance, where it pushes the risk back to the owner. When you have policies built like this, you cannot get any closer to a universal life illustration,
right?
Where the risk is on the consumer. What risk, James? I'm not going to lose any money unless I don't pay a premium. The risk that it is going to perform anywhere close to the illustration. That makes sense?
Mm-hmm.
All right. So this is just one case, one example, great conversation. I really think it's a great episode, but there is more.
Yeah.
Right.
And the thing with him, it's like, I don't want to just be beating up for the sake of it, but like the actual experience, this individual's actual experience with those policies in the event that he keeps them, which if he wants to, fine, will diverge from what he was told, right? Where it's kind of the opposite of like planting a seed that grows into a tree that serves you for a long time. It's more like planting a future liability, right? We're planting the seed of unfulfilled expectations, of disappointment down the future. Nobody wants to receive a letter in the mail saying, "Oh, you got to pay more money to get the same or less than what you already have," and then have that repeat year after year. And especially for somebody who, and I think this is a lot of people, right? And maybe it includes some of the agents who watch, but I think it is a lot of people. There's no social media ad buying here. There's no like clever marketing to place or situate the podcast anywhere. But the guys who are doing this stuff, they do that. So
they stalk.
Yeah. And so if you do a general search, you're going to come across a lot of this, and you probably already have. You may even own policies that are built the same way. You may be sitting here watching this thinking, oh my gosh, that sounds a lot like what I own. I wonder if it is. Well, it's okay to go back and read over the illustration and the contract. And if you don't have one, you have a right to get them either from the agent or from the company. And you should know what you own. But that's what irritates me, is that whether knowingly or not, and it's beside the point, the client who buys into these kinds of constructs is going to form expectations. They think that the premium on the illustration will be payable. They think that they'll have the ability to pay it for a long time. They think that what those numbers illustrated in the cash value are dependable, right? And all of that's implicit, it's unspoken, it's assumed, and there's never any critical analysis of it. And so, but then all we want to do is we want to compare numbers on a page. It's like, well, is it a real number? It's like economic statistics from the Soviet Union.
You're being generous.
It's Soviet GDP is what these illustrations are. Yeah. And so you want to depend upon that? Well, are they real numbers? Well, how do we know if they're real numbers? Well, you got to read the contractual terms and conditions of the various writers. And once you do that, you'll start to see, oh, well, maybe that number's not going to be payable. Maybe that cash value isn't going to be there. And look, if all of that was done up front and you knew that what was on the page is made up and you still wanted to buy it, okay. Go full steam. As long as you have full information about what it is you're getting into, great. Do what you want. I'm as libertarian as they come. But my issue is very often in virtually every case that I've encountered is that all of this sort of nuanced understanding is set aside, is totally ignored. It's coupled with a sign here, sign fast, get it done quick, pay a premium as fast as possible sort of mentality. It's all automated, right? It's all in the ClickFunnels. The illustrations are all the same, so they're very easy to put together.
Speaking of pressure, a couple of these, and maybe yours, I don't know, the 7702 change was effective. The hard deadline was January 1 of 2022. So some of these were built and delivered in December of 2021 under that pressure. You've got to do this now. You've got to do this now.
It's used as a marketing gimmick.
Here's a couple of points that I want to make. This is a particular case. I spoke about this one at the think tank here, and this is just, it's egregious to me. 42-year-old female, right? Okay, so the background here, she calls our office and says, hey, sends the illustration. She said, I've discovered the infinite banking concept online. Love it. Went all in, then discovered your podcast. Here's an illustration. Do I have a 30-day free look period?
What's a free look period for people?
Free look in some states are 10 days free look. Other states are 30-day free look period. Once you take delivery of a policy, there's a delivery document. This date you're signing a document that says delivery, and it has a date on there. That date marks the free look period, the beginning of the free look period. We're in Texas currently, but we do business across the country. States are different. You have 10 days or a 30-day free look period generally. I think that there may be a state or two with 20-day free look, but I can't recall. That delivery document, when you sign that electronically or physically, that marks the beginning of your free look period. And the free look period is exactly that. It's a period of time in which you can say and decide, I don't want this. Send it back to you call them the life insurance. I do not want this policy. The premium is sent back to you. The policy is, in fact, never in force, and it's a free look period. So whatever you paid in premium, it all comes back to you. But it's it's hard dates, right? And so the agent would get a charge back if you did that, and so they're going to tell you every reason not to. And I'm not telling you to do this. I'm not telling you to replace anything. As a matter of fact, don't change anything unless you know what you're doing. Mm-hmm. And you can know what you're doing by working with a competent professional and multiple professionals. Maybe you have an attorney, maybe you have a CPA, maybe you have a competent, knowledgeable financial advisor, life insurance agent that has your best interest at heart. What a place to start. Okay.
But they've got to be able to explain to you what you already own. Otherwise, you're just wandering around in the dark. Yeah. You were telling me about a story about Jake earlier, and I obviously have done it so with this case. It's like, bring what you have. Let's go through it. Make sure you understand it. Once you understand it, then you can go and make your decisions.
Right. Yeah, that's another whole case. This particular case, that's how it started. She did this, right? And it was all under the pressure prior to 7702, December. And she gets the policy, right? And the illustration. So here's the background. She's 42. She wanted to pay $5,000 a year for her retirement in the future. And she is subject to work till she's 70 years of age. She's 42. Okay. And her husband thinks the whole IBC thing's a gimmick. All right. But she goes forward and does it anyway, paying $5,000 a year in premium. Well, the illustration that she signs at delivery, which must match the premium, okay, shows $5,000 a year for 7 years. And she calls them and says, this is, I want to pay $5,000 a year until I retire. Can I pay a premium after year 8? They said, oh, yeah, sure. You can pay $2,000. That's not what I asked for. And so, my point here, and this is not an NNI practitioner, it's just somebody with a life insurance license that actually answered their phone, right? But the guy presents like he's practicing the infinite banking concept. Great company, wrong product, because it's heavily dependent upon a non-guaranteed dividend. And then the structure is 60-40. 40% of the $5,000 premium is paid to the base, 60% to the PUA, which there's nothing per se wrong with that. With a 7-year term rider, she's 42. Yeah. She must reduce the premium at her age of 50. Right? And she's got 20 more years till retirement. So why did they do that? They looked at an illustration in Nelson's book that showed 7 years of premium. They looked at another illustration, maybe in Nelson's book, or heard somebody talking about Nelson Nash and some of the illustrations that he did in Becoming Your Own Banker, and did a 60-40 split. I have no idea. Why do you use a 7-year term rider? All of this is because he doesn't know what he's doing. She asked for what she wanted, and she was delivered something that he could high pressure get her to sign and take delivery of. All right. And I want to say this, take this away, right, for you, the listener. When you look at a life insurance illustration, all policies today are constructed to using the age of 121 years as a life expectancy. Just go out to year 120, look at the guaranteed cash value compared to the non-guaranteed cash value. And here's an example of what I mean that I didn't get to, but I'm going to get to the point here. High premium policy, young individual, very productive, very successful, pays almost $1 million in premium on one of these contorted policies for, 7 or 8 years. And as Ryan said earlier, don't let the premium take 2 digits off. I don't care if it's 10,000, 100,000, 2,000, 5,000, whatever the premium is for you, embrace it, right? We're not trying to throw out big numbers to be impressive at all. That's this particular case. I go out and before we sit down, I'm like, well, let me see that illustration because I know what I wanted to point out, and just checking to confirm what I wanted to point out was in fact true. So I looked at the illustration at age 121 on the guaranteed side of the ledger at age 121, the end of 120 years, right? You're at 121. $2 million in guaranteed cash values that is not necessarily going to happen because the company's going to pay some dividends and there's no telling what kind of a premium he is actually going to pay. He can only pay a high premium for a limited number of years. But all things being equal on the same illustration, 4 or 5 columns to the right, there's the non-guaranteed cash values. What do you think the difference is? And I asked Ryan this before. Maybe it's on B-roll. There's $2 million in cash value.
Yeah.
What did you say when I said, what do you think?
My first number was $5 million.
$5 million.
And then 7. And then 10. And then 15.
And then he's not believing me. He's raising his eyebrows like
20, 25, 30, 50, 55 million.
No, 51 million 51 on the non-guaranteed side compared to 2 million on the guaranteed side. You tell me, and if there's rocket scientists listening to any podcast, they're listening to this one. And you don't even have to be an attorney or a rocket scientist. I don't even have to get above 3rd grade math. What do you think is going to be closer to reality? And I know I'm going over a long time period. I get it. What do you think is going to happen? Neither one are going to be true. It'll be more than 2 million, but it won't be anywhere near 51 million. Nowhere near. So the point that I'm making here is you, the consumer, if you're looking at illustrations, and you shouldn't until you have a thorough understanding and comfort level of what's really going on. And I'm not saying you shouldn't. Look at Nelson's book. There's illustrations in the book. Go to the year 120. The greater the disparity should tell you something. Okay? And then I want to close with this for me. And I might keep talking. I don't know. I can keep going all day. Okay, listen. This is a quote from my watchmaker friend. Had a couple of conversations. Soon to be a new client. Talked to him several times. Great guy, salt of the earth. You would love him if you met him. Looking forward to meeting him. And this individual happened to have purchased Universal Life. All right. Paying high premium. And he discovers the infinite banking concept. And then he's come to the understanding that this is probably not the best for him. So he just wants to have it corrected. But he's only 3 or 4 years into it. I don't know, $97,000 in total premium between him and his wife. He had no idea of the surrender charge or the difference between an account value. So you're looking at a universal life illustration, there's always an account value. And they'll play games with, call it a cash value. No, it's an account value. Then there is with universal life, all universal life, a surrender charge. These surrender charges on this man are from 13 to 19 years, depending on the age in which you were when you purchased it. All right. So he's like, I have this much in the account value. Can't we do something with it? And I'm like, no. So what are you talking about? See the account value? Yeah. See the surrender charge? Yeah. See the net surrender value? Yeah. That's $55,000 less than what you paid in premium, right? And about $35,000 less than the account value. That is what you can collateralize or 1035 exchange or take in surrender value. He had no idea. This is a smart man.
Yeah.
Right. So this is his quote. I loved it. And I asked him, I'm like, can I use that? He said, sure, you don't have to give me credit, but I'm giving you credit. They'll pull every crayon out of the box to create the illustration, won't they, James? And yes, they will.
You were mentioning earlier about the short-dated term rider, the 7-year. She was 42. She wants to pay till 70. She can only pay the PUA for 7 years. And the reason is because you have a 7-year term rider. And we were talking about my Facebook post the other day that I made the other day. And one of those was on this phenomenon of short-dated term riders. And the 1-year term is just a very extreme version of that. It's the shortest possible term you could have.
Worst version of that.
Yeah. But there's a 1 year, like I was saying in the case of Bob, he could have a 30-year, a very long dated one. So that, there's quite a range of possibilities.
And it depends on how old you are, what makes sense.
Sure.
Individual.
Yeah.
Right.
But for a lot of people, 30s, 40s, even 50s, a 20 to a 30-year term rider is the idea is as long dated one as possible, given who you are, and why not have the authority to pay a PUA for as long as possible if you could get it. And so, but what I'm noticing is that it within the IBC community, they're not 1-year term riders. The people using the 1-year term are often not involved within IBC or within like the Nelson Nash Institute.
Right.
But there are people who are doing IBC and they're using 7-year term for people in their 30s and 40s. And the rationale that's offered is out of becoming your own banker. And bravo, if we're quoting, I think in the post I said, if we're both quoting from Nelson Nash, then we're already homies. We're just splitting hairs right now. But the section that is often cited to justify, right? Because the idea is, okay, once the term rider expires, we'll just go expand the system because this is about getting a system of policies. And I'm like, what did Nelson really say in that passage? Okay, well, here it is. Page 25. He says, furthermore, I am not describing one life insurance policy. This is to be a system of policies. Have you not noticed that when a grocery store becomes successful in one location, then it tends to establish another store in another location? Have you not noticed that banks have branch offices? There must be a reason for their behavior. Then why not expand your own potential by buying all the life insurance on yourself that the companies will issue, and then on all the persons in which you have an insurable interest? At present, does not all your income go through the banks or go through the books of some banking institution? Don't the banks lend out deposits of customers? All they do is capitalize the bank to make it safe for customers to deposit their money and then lend out the money left on deposit. If they don't lend out the money, they will go out of business. It will take the average person at least 20 to 25 years to build a banking system through life insurance to accommodate all his own needs for finance. Okay, so that's where this system of so take a close look at what he's saying. He's like, look, if a bank or any business is successful and they're doing well, it's natural to then expand and start another branch. In the context of IBC and life insurance, that means start another policy. But I'm like, wait, if I have a successful branch and I'm then going to go open up a second one, do I start to fuel the new branch at the expense of the former one? Do I start to neglect The older, by the way, probably more efficient, right? The loan officers have been there longer.
7 years, 8 years, 10 years old. That policy is just becoming at the early front end of an exponential curve efficient.
Yeah.
It becomes more efficient over time, just like the airplane.
And of course, it's a rhetorical question. It's like, no, I would much rather, if I'm successful, if the banking business is going well, of course I want to open a second branch.
Well,
but I also want to continue to contribute to the ongoing profitability of the older branch. And just like you said, the older branch is more efficient. In insurance terms and IBC style policy terms, the cash value is growing faster per premium dollar as the years go on. Why wouldn't I want to continue to throw fuel on that fire? Yes, is there a system of policies? Yes, is there a time to expand the system? Yes, is there a time to go get another policy? I have 3 of them. I started in 2016. There's a time to go get more policies. But in the policies we purchase, we should want to, my opinion, we should want to maximize the duration, maximize the number of years over which PUA is payable. And in general, that requires a long-dated, in my view, it should be a level, meaning premiums contractually fixed, term rider. Now, you don't have to do that, right? You can do a structure where there's a bit more to the base, a bit less to the PUA. You don't need the long-dated term rider in order to be able to pay a PUA for, let's say, 20 years. Okay. But to get out to 30 years, you're going to have term on it, period. And especially if you want to do more than 50% of the total outlay to the PUA.
There's a couple of points there. Would you point out where he said, once it's successful or when it's successful, they expand?
Have you not noticed that when a grocery store becomes successful in one location, then it tends to establish another store in another location?
Thank you. Just right there. Because you made a good point and a great point. And my point is, when is a policy successful? All right. So on the first policy, properly built, it's successful from day one. Okay, because you got to lay the proper foundation to build whatever structure you're going to build on top of it. All right, and then we're talking about expansion. You're at 3. Nelson had over 45. Right, expansion occurs naturally. Right, what you understood when you started is not what you understand today, right? You're going to learn more. You're going to know more. You're going to do more. Naturally, expansion occurs naturally. So when you properly construct a policy, you may not know how you're going to get the premium 30 years in a row, but it's not a contractual obligation. It's a contractual right that you have compared to the high, 300,000 in the first year, and then I'm only going to illustrate 100,000 from every year after that. When is a policy like that successful? On the guaranteed side, never. On the non-guaranteed side, that's probably not going to happen, maybe in years 6, 7, or 8. And then I'm just talking about a crossover point that is total premium paid, cumulative premium compared to cumulative cash value. And now I'm just picking a point in time in the future. I'm using that terminology of when is a policy successful? When it started, when you own it, right? And every year it just becomes more and more and more efficient. You can't get everything that you need past the underwriter in the beginning. Rarely can you. I've not seen it in my 30-year career of getting everything that I need in one policy in the beginning past an underwriter. The natural expansion occurs to the point where the underwriter is going to say, no, you can't have any more on your life. So then you must look at everybody that you have an insurable interest in, right? And just because they're younger doesn't mean that's where you start, right?
And by the way, the amount you can get on other people is determined as a function of the amount you have on yourself.
Right.
So if I'm not able to pay as much premium to buy as much death benefit to generate as much cash value, I'm reducing the amount I can get at a maximum on other people. It is in our own interest. Like if we want to implement IBC and pay a high premium throughout our lifetimes and to continue to expand the system, we should want to have as much coverage as the company will allow and that we can pay for on our own self first in policies we already own, so that when we do become fully insured, which at some point you will be, then when you go to insure other people, you can get as much as your circumstances would have allowed. But by using an abbreviated or shortened term rider and reducing your ability to pay PUA and therefore to generate death benefit in these policies, we not only have like we mentioned earlier, we reintroduced underwriting risk, both medical and financial underwriting risk. Will the future insurable interest even be intact in order to justify an application in the future? Who knows? The future's uncertain. We introduced that risk, but we also, in general, just slow the pace of cash value and death benefit generation because we're restarting the life cycle of a policy. And just like you're saying, life insurance, dividend paying whole life insurance built for the IBC becomes more efficient over time, which means that it's less efficient earlier on. So if I'm restarting a growth process, I'm restarting the most inefficient growth segment of the life cycle, and I'm doing it at a later age if I have the insurable interest to even get the application past the underwriter. The net result of that is I'll have less coverage on myself at the time when I want to go insure other people, which means that I won't be able to pay as much as I otherwise could have on those other people.
And look, you're talking about family members. If I'm going to buy a key man policy, I'm all on an employee, on a key person. If I'm going to do an executive bonus, if I'm going to do a charitable organization is maybe insuring their donors or their board members, it's very limited already what death benefit will be insurable, right? So as just to throw out numbers,
very limited.
Very limited. So that if it's limited on the face amount, then it's greatly limited on the premium. So a natural expansion is the people that you have the most insurable interest in. They could be business partners, there's no doubt. But there's a natural expansion. But you're very limited on what you can even have on yourself, and you're even more limited on what you can have on other people. And let me say this, and I don't remember where it was, but you were looking through the Becoming Your Own Banker and talking. Nelson said that a proper selection of life insurance, and then he refers to a paid up at age 65 or a paid to 100 policy. And it's around the MEC tables, I believe.
I know what you're talking
and maybe
about.
I'll find it and put the reference in the notes. He properly selected life insurance payable to 65 or payable to age 100, and then added PUA, right? So he might illustrate premium payments for 4 years in equipment financing. Premium was paid all the way to that man's age 65, and he was 30 at the beginning. Premium was being paid. Where did the premium come from? So these contorted illustrations where you're forced to reduce your premium because of a 7-year term rider or a 1-year blended term rider PUA is not IBC. It is not the infinite banking concept. And then, hear often, well, James, what if you're going to pay $1 million and there's $100,000 to the base? Okay, well, if you can pay $1 million in premium today, why can't you pay $1 million in premium tomorrow? Right? This over construction of a policy to get what I call an artificial liquidity at the cost and at the expense of that policy in your future years is nobody would do that if they understood what was going on, in my opinion.
Yeah, you raise a really good point. So, and just to cite some of a specific example in equipment financing, and if you have the book, you can look at it at home. But we see there's a net annual outlay column, right? That is not a premium column. It is a net annual outlay column. Okay, and it says $40,000 per year for the first 4 years. It just so happens that those outlays are premiums. Okay, but in year 5, illustration number 2, page 59, it says negative $34,600. Okay, this is the taking of a policy loan and then assuming repayments in the amount totaling $18,000 per year in order to pay for the first truck.
Yeah.
And then in years 6, 7, and 8, we see a net annual outlay of $18,000. Okay, so this is then, and those are quote unquote repayments, right? $1,500 per month, rounded. It comes out to $18,000
And he's
per
matching what the gentleman was doing with Associates Finance.
Yep, just redirecting cash flows. But here, the reason I brought this up is this is how you can tell that there is still premium getting paid. If you look at the annual loan column, fourth from the left, in year 6, it says negative $12,551. In other words, there's a reduction in the policy loan in the amount of $12,551. But the net annual outlay is 18. He paid 18, the loan went down 12,551. Where'd the rest of the money go? And the answer is PUA. And that happens in 4-year chunks all the way through. So there is premium getting paid after the first 4 years. Now, the base premium is getting paid as well, but it's not coming from the individual's own pocket. Nelson says in here that the assumption is that in the 5th year and beyond, the dividend is assumed to be paying the base premium. And he goes on to say that.
And the dividend is not sufficient to pay that base premium until about the 17th year.
Right. So it's a combination. It's called premium offset. It's a combination of reallocating the dividend, right? Telling the company, look, keep the dividend, use it to reduce the base premium. And if there's still some base premium due that the dividend can't cover, surrender some previously purchased death benefit.
PUA surrenders, and that's the far right column. You'll notice the death benefit goes down because of that.
Yeah, so the base premium is getting paid from policy value, sometimes called PPV, right? A combination of the change in the dividend election and partial surrender. So the base is getting paid, but there's an $18,000 outlay going to the life insurance company. And in year 6, $12,551 of that is reducing a loan. The rest of that money, the difference between $18,000 and $12,551, must be going somewhere. And the only other option is PUA, right? So you can't, if you know what's going on in these illustrations, you can't look at equipment financing and say, oh, big high premiums for the first 4 year, no, quote unquote, no premiums thereafter. That therefore, when I'm helping clients today in 2022 or whenever you're listening to this, we're going to use the shortest dated term writer possible because this is about a system of policies and you're just going to expand and the insurable interest will be intact and there will be no underwriting problems. And by the way, we'll restart the commission cycle, but that's a whole other point.
Look at all that liquidity you have in year 1, right?
Yes.
And this illustration was built in 2000. All right. And my point here is that there have been 2 CSO table changes, commissioner standard, ordinary tables. The life expectancy in which they use to calculate and construct a policy, right? This was a 1980 CSO table at best, and the life expectancy was age 100. And then, and these changes are important, we had the 7702 change here in January 1 of 2022. And my point being, and he even talks about this, right? He said these are based on 1980 illustrations or 2000 illustrations when the book was printed. And here we are in 2022. And so I think that agents just try to short pay a premium to match these illustrations, and they have no idea what's going on in that illustration. None. And tell me, why was that $15,000 premium being paid through dividends and premium PUA surrenders? Why? Because it's the obligation out of the $40,000. The $15,000 is an obligation. That's a paid up at the 65 policy. It's going to be paid whether he wrote a check for it or not.
And it was just so wild because if people would just relax and read Nelson and like accept what he's saying, the results are even better than what is used as an example, right? If base premium would have been paid out of pocket like it should have been, if the dividends were allowed to go back into the policy to build more death benefit and contribute to cash value growth, if the maximum PUA had been paid rather than just this about $14,000 over the course of every 4 years, all the numbers get bigger, and the numbers are already big. So it's like
went out of his way to build these illustrations and said many times he would never have done that again if he had it to do over again, rewrite, he wouldn't do that. And I wouldn't either. The amount of time, effort, and energy it took for him to do all that, I would not do that.
To square these numbers away, yeah.
Oh my gosh. But we could talk about that forever. Why is the death benefit the way it is? You know, how inefficient is that policy? Right? When should that guy have started another policy? Could he have started sooner? Could he have started financing sooner? And if so, how? There's an even distribution of age classes and equipment financing and becoming your own banker. If you are solidly on the understanding of those two constructs with the concept of that book, you don't need all of these contorted new books and people out there bastardizing his work to make a good and thorough decision with understanding. You don't need them, in my opinion.
It's so weird that, the emphasis for some reason is on the cash value as a percentage of the outlay in the early years. But what about the bottom third of each one of the illustrations where Nelson is showing high payments, quote unquote retirement, but passive cash flow, tax-free
and those are withdrawals.
These are withdrawals that not even, it all could have been done better. In the addendum, he says that if he were advising a client, it would have been through policy loans. But the idea is that we're being long-term oriented. We're thinking about what kind of cash flow this whole system would produce. All the examples in the book assume that there's going to be passive cash flow late in life. But that part is never, what's this policy going to do for me in the long run is always neglected in order to emphasize cash value as a percentage of premium in the first year.
Well, look, Ryan, I'm 55 years old. I don't have 35 years to pay these big premiums and all that. So what can you do? Oh, I can manipulate an illustration without you knowing what I'm doing to show the bigger, higher premiums in the beginning year, right? You can't think long range? Really? How old is your youngest child, listener? How old? And how fast did that time go by? I'm just asking. So I may not live for 50. I'm not going to live for 50 more years. But God willing, my daughter and my children will be here in 50 years. Oh, wait a minute. And they'll probably have prodigy. And I can't think in terms of 50 years. I can't think beyond my own life expectancy. Well, dang, how short-sighted do you want to be? Why can't I think 3 generations into the future? Oh, wait, I can. Yeah. So this idea of time periods, let's just talk through that, reason through that. Do I want to become less efficient as soon as possible? No. The most efficient policy you'll ever have is the oldest one you own. Well, that would be policies on my youngest child, me personally. Right? I'm not going to be here to see it. Neither are you. Right? But I'm not going to be here to see the fruit tree that was planted, 10 years from now. I'm not going to enjoy that fruit 30 years from now. What does that mean? That I shouldn't do it? Nobody else should have fruit? Legitimate questions.
Yeah. That was a good one.
Yeah. I think it goes viral. I don't know, either because they love us or hate us or both. Right? I had fun.
Yeah, me too.
So there's more. Just saying there's more here. Okay. Thanks for listening. I really did have fun, and I hope you enjoy.
Bye, y'all.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.